In Accounting 101, you prepared financial statements, didn't you? You did balance sheets, right? You did income statements. So what this chapter is all about is just analyzing our financial statements and saying, how'd we do? So not just preparing, but analyzing. And we've got really three methods of analyzing our financial statements. So horizontal analysis, we compare this year's financial statements to last year's financial statements. It's just basically analyzing, if we're improving or doing worse over time. Vertical analysis is the other thing we're going to do, and that's looking up and down on the financial statement. An example would be our gross margin is a certain percent of our sales. Our research and development, 11,000, is a certain percent of my sales. So it's comparing each thing on here to one other number on the same column. Okay, that's vertical analysis, and we'll be doing some of that. The other one is ratio analysis. Guys, this is simply a review of Accounting 101. If you recall, we had like a few ratios in every chapter. We had the current ratio, the acid test ratio, the debt ratio. This is just a review of all those ratios. So we'll talk about that a little bit as well. And we're going to work 3 homework problems in Connect. You can just watch me do them, and then if you have trouble, you can go back and rewatch the recording. But we'll go over that. Let's look at, let's just start with the horizontal analysis. So one important formula is to calculate the change in something from this year to last year, or from last year to this year. Our net sales, for example, last year was 215, this year is 229. So the dollar change is 13,595. And one thing you'll notice is we always put the most recent year first and then the prior years after it, because the current year is what most people are going to want to look at anyway. The dollar change is just 13,595. That's how much it increased. In fact, all these numbers increased over last year, didn't they? Now, the percent change, to calculate the percentage by which this changed. So we say it was 215 last year, and this year is 229. So, it went up by 13,595. But what percent did it go up? It's a 6.3% increase over last year. So the percent change is the dollar change divided by the base year, the initial year, not the current year. So remember that, that'll trip you up for sure. Okay, let's practice horizontal analysis in Connect. This is number 1 in the homework and the practice. Here's the current year numbers, and that's where it was last year. And this is based on our balance sheet, our short-term investments, accounts receivable, notes payable. These are balance sheet accounts. These are asset, liability, right? This is a liability, a note payable. They want the formula first. So what is the percent change?
Yes, the current year minus the base year.
Yeah, so it's this year's minus last year's. That's the amount that it changed, in dollars. And we divide that by the base year amount, of course. How much did it change? 374 minus that. It went up by 140,634. That's a 60.1% change. So it went up by 140,634 over last year. And if you take this divided by the prior year, you get 60.1% change. That's a big change, isn't it? What about accounts receivable? It went down, didn't it? So it went down by 3636. Yeah. So it was 97. No, it was 101, and it went down to 97,364. That means it went down by 3636. So put that negative. And the percent change, if you take this negative number divided by this positive number, you will get a negative in your calculator percent of that. All right. So be sure you make that negative if it went down. Our notes payable went from 88 to 0. So that went down a big chunk, didn't it? It went down about 88,000. Negative 88,000 divided by 88,000. 1, right? Well, 1 is 100%. So that's why it's a negative 100% change. Okay, vertical analysis. These are sometimes called common size financial statements. What we do with common size income statements, we take one number on the financial statement that we want to compare everything else to. So here they've decided that net sales are going to be what we compare everything else to. And what this common size statement here is saying, that our cost of our sales, the things that we sold, what did they cost us? It was $141,048. All right. And that is 61.5% of the sales revenue. So our cost is 61.5% of the revenue. More importantly, and this is a number a lot of people look at, our profit is 38% of our net sales. Of the amount 229,234 that we sold, you know, the revenue we got from our customers, 88,000 of that is profit. This part, this is what we paid to buy the stuff. So that's out the window, right? But this is our profit. So our profit percentage is 38.5% profit. Now that's not our end of the day take home money, is it? Because we have these other expenses down here that are going to take it away from us. But still, look at this. Our net income is 21% of our sales. So everything is a percent of the top number. On the balance sheet, I think I can make this bigger for you. On the balance sheet, we compare generally everything to total assets. In the assets section, we compare everything to total assets. So see how we set this equal to 100%? Everything above it is a portion of that, right? You know, what makes up our total assets? Well, what is the biggest part? What is the biggest component of our total assets? Can you just look at this and tell me what makes up most of our current assets, of our assets?
The long-term marketable securities.
Yeah, right. And cash is only like 5% of our total assets. That's good, right? Because you don't want cash sitting in the bank because it's just doing nothing for you. You want your cash to be invested in things that are going to earn you money. Look at these short-term marketable securities. This is an investment. This is earning us interest. Inventories. Is this good that our inventory is 1% of our total assets? It costs money to store inventory. And also, if we have inventory sitting there, this is stuff we bought and we haven't sold it yet. So we have made zero money on this. So it's tied up in inventory. So we generally want to minimize this as much as possible. So these look pretty good to me. So let's do number 3. Determine the prior year and current year common size percents for cost of goods sold. For cost of goods sold, okay. So I want the common size percent for cost of goods sold. Now, what's my base going to be? Net sales. All right. I want to know what cost of goods sold is as a percent of my net sales. And so we're going to take the cost of goods sold divided by the net sales. So for the current year, right here, my cost of goods sold is $392,887. And also for the current year, my sales is $801,810. So that would give me 49%. Yes, and you can do the rest of your own. You just do the same thing with the prior year. So yeah, our cost of goods sold is basically half of our sales. And again, what that means is, customers, we earned 801, 810 selling things to our customers. But half of that is just what it cost us to buy the stuff. What do we have to work with here? 51%, right? And the rest of that has to go to paying the other expenses, right? We are not going to talk about ratio analysis in this meeting today. This is basically plugging in formulas. All right. Remember these ratios from Accounting 101, current ratio, asset test ratio, accounts receivable turnover, all these turnover ratios, debt ratio, equity ratio. It's basically plugging numbers in and getting the answer. So I don't want to waste your time going over the mechanics of that. I just want you to know that these ratios are very important to the shareholders. So as an accountant, one of the things you're going to do after you prepare the financial statements is do ratio analysis, like do all these ratios. This one here is particularly crucial to the shareholders. Debt to equity ratio. How much debt does this company have as a percent of their equity? Because if this number is too big, it's not good, is it? These numbers are all very important to the shareholders. Oh yeah, this is a important number here, working capital. So just know the definition of working capital. It's current assets minus current liabilities. That's called working capital. But that's about all I have for you today.